ETFs. The second and most important step in ETF investing involves researching them. There is a wide variety of ETFs available in the markets today. One thing to remember during the research process is that ETFs are unlike individual securities, such as stocks or bonds. You will need to consider the whole picture, in terms of sector or industry, when you commit to an ETF. Here are some questions you might want to consider during the research process. What is your time frame for investing? Are you investing for income or growth? Are there particular sectors or financial instruments that excite you? Consider a trading strategy. If you are a beginning investor in ETFs, dollar cost averaging, or spreading out your investment costs over a period of time is a good trading strategy. This is because it smooths out returns over a period of time and ensures a disciplined, as opposed to a haphazard or volatile, approach to investing. It also helps beginning investors learn more about the nuances of ETF investing. When they become more comfortable with trading, investors can move out to more sophisticated strategies like swing trading and sector rotation. Advantages of ETFs. Diversification. ETFs provide a simple and easy way to invest in a diversified portfolio of assets. By investing in a single ETF, an investor gains exposure to a range of stocks or bonds, which can reduce risk and increase potential returns. Lower costs. ETFs typically have lower fees than mutual funds because they are passively managed and do not require active management or research. This means that the costs of ETFs are generally lower than mutual funds. Tax efficiency. ETFs are generally more tax efficient than mutual funds. When investors sell mutual fund shares, the fund must sell some of its holdings to generate cash for the redemption. This can trigger taxable capital gains for all shareholders. ETFs, on the other hand, can be sold on an exchange, and the buyer and seller assume the tax liability. Transparency. ETFs disclose their holdings daily, which provides investors with transparency into the assets held by the fund. Trading flexibility. ETFs can be bought and sold throughout the trading day, which provides investors with greater flexibility compared to mutual funds, which can only be bought or sold at the end of the trading day. Disadvantages of ETFs. Liquidity risk. ETFs can experience liquidity risk if there is a lack of buyers or sellers in the market. This can result in the ETF trading at a premium or discount to its net asset value, NAV. Tracking error. Although ETFs are designed to track a specific index or sector, there can be slight deviations due to tracking error. This can result in the ETF underperforming or outperforming the underlying index. Brokerage commissions. Investors must pay brokerage commissions when buying and selling ETFs, which can add up over time and erode returns. Limited control. ETFs are passively managed, which means that investors have limited control over the underlying assets held by the fund. Guys, we are at the end of the video. If you have enjoyed this, please make sure to hit that like button and share it with your friends and family who might also find it helpful. Your support means a lot to us and helps us continue creating content like this. If you haven't already, don't forget to subscribe to our channel and click the notification bell so you never miss out on our latest videos covering a wide range of topics related to investing, the stock market, the crypto market, personal finance, and more. If you have any questions or suggestions for future video topics, please leave a comment down below. We love hearing from you and always appreciate your feedback. Once again, thank you so much for watching, and we'll see you in the next video.